There you go.
Hello traders, Cousin Benny coming to you from theclosingprint.com on October the 2nd, 2016. In this edition of your weekend video newsletter, we'll cover the indices, all of which closed higher for the week. Tick and Tick-Q reflect institutional sentiment that is still bullish, crossing up and trending in both cases. The summation index crossed and is moving sideways, so there's really no signal there in terms of NIMO, NAMO, and the breadth of the two. However, NYHL is bullish since March and continues to be so. It moved higher during the week and closed at its highs on Friday. High-low percent is 82.45. That's plus 15 in a week's time. So that breadth indicator is looking pretty smart. Up-down volume is mostly bullish. And we see CPC, the put-call ratio, is heading to the green zone, but there's no signal. It's at 1.01, which is basically flat. VIX declining to 3.29 would be perceived as bearish. And of course, currencies, we have the dollar neutral. There is some news that the yuan has joined the IMF, but the US dollar percentage remains the same. The euro and the yen, as you might suspect, dropped a bit in their percentage of that basket of currencies, making room for the yuan. Bonds, TLT is flat. Short-term yields 2, 5, and 10 are providing a tailwind for US equities, being that short-term yields faded and moved a little bit lower. AGG is flat as well as the UST SPX bond stock ratio. It's flat to lower, so that's slightly bullish. It's more bullish than bearish. And we have crude bullish with an 8.45% increase on the week. We talked about that over the last 2 weeks, that inverted head and shoulders. We'll cover that. Copper is higher and gold is lower. The XLP XLY ratio is moving lower. That's bullish for equities, and XLE, IYT, and XLI, all three are bullish, but the latter two are part of Dow theory, and that looks bullish as well. XBI, we saw a buying at the 20 EMA, and the heat map is trending. We've moved from red to yellow and now starting to see bits of green. We have a dovish Fed supportive of higher prices. We have no rate hike affecting yields and bond prices, and the Fed is buying stocks now, which is kind of odd in that they are getting involved in areas where most economists feel they shouldn't. That said, the bottom line, we're more bullish than bearish. You can see there's a lot of green on the screen here. And we'll look at some IBD 50 setups, which look pretty decent, especially in semiconductors. Volkowski, we have 4 or 5 green, and his CPI signal has been bullish since 9/19/16. And last but not least, we have fund managers, cash levels supportive of higher prices going into the new month. Here we have a look at the SPY, continuing to compress inside of this triangle pattern, if you will, with lower highs and higher lows. We've held the 236 Fibonacci level, and we've been having some trouble getting through this volume by price band, which, if you've been following the block trades, we know that there's a lot of blocks up above those levels that are hindering prices. So that aligns right there as we would expect, and it needs to be surpassed in order to move higher. Now, the positive things are we are on a buy signal for over 2 weeks. Prices continue to oscillate, trying to close above the 20, the 9, and the 50 period moving averages. We have RSI oscillating around 50. That could turn up just as well as turn down, but we're looking for it to turn up. And the reason being is the sectors are rotating in the right direction for a bullish continuation, moving from red to yellow to green. And the whole purpose of the creation of this spreadsheet that Ron Patel put together is to follow this heat map, moving from green to yellow to red, and then back from red to yellow to green. So we look for this rotation that continues. More than likely we will see higher prices. In addition, MACD is continuing to move higher on the SPY, and stochastic has room to move to the upside. We had higher volume, though it didn't surpass Thursday's volume. It was above average and more than likely will continue. Now let's take a step back and look at the Wilshire 5000, which is a composite index, obviously, of 5,000 stocks, which gives us a broader measure or barometer of market conditions. Okay, the thing I want to point out here is looking at where RSI is compared to previous tops, trends lower, and bottoms. In this case, we experienced a bounce. RSI is moving in the opposite direction versus what we saw back in 2008, 2009, where we all know what transpired. With RSI moving higher, this gives us a different look and is more bullish than bearish at the current time, having broken above this 2-year range. Again, back in 2000, we were at point B above 70, overbought on RSI, moving lower. We bounced, we moved sideways, and then we started trending lower until we achieved oversold. So this doesn't look anything like in 2007, 2008, or in 2000, 2001, bottoming in 2002. Again, if we look at MACD, where was MACD during this time period? We crossed over and moved lower. Right now, we're crossing up. Look at the volume. Look at the volume here. Substantially more volume over the past 7 months than we've seen in these periods leading up to the dot-com bubble and the financial crisis. So until we start to see bearish tendencies, this looks more bullish than these occurrences where MACD rolled over and dropped below the zero line. We're above zero, so that is positive. So with regard to a wider or broader market measure using the Wilshire 5000, the current time looks nothing like previous times where we crashed and moved lower. Well, what about the NASDAQ 100? We have the monthly chart here as well. We saw the peak in 2000 where prices dropped. Look where RSI is. Right now, RSI is trending higher, having bounced at 50. Even in 2008, we saw the same thing. We saw a bounce and then a drop lower. But look at price action compared to now and then. Look at MACD, was dropping below the zero line. In this case, we rolled over from just above zero and then turned lower. Where are we now? We're above zero and turning higher. Now, we could turn and move back down. We'll have to watch for that as well, as stochastic is embedded again. So when considering which direction the markets are going, remember to zoom out in your time frames and compare previous occurrences where prices dropped dramatically and compare them to the present time. That'll help you with your game plan for the months and weeks ahead, which, by the way, is the strongest months of the year, October through March and April. VIX is at lows, showing some complacency. NYMO and NAMO are flat, really not giving us much to go on. So we're not going to cover those this week. What we will focus on is breadth with regard to 52-week highs and 52-week lows. The high-low index, new highs, new lows, comparing those to the 52-week highs, 52-week lows, continues to trend higher, which is a good sign. It's at 82.45. That increased a full 15 points over the last week, which is an indication that institutions are buying and stocks are moving to 52-week highs. The NYSE composite of 2,000 stocks is back above its 20-period EMA, as you can see in the Zoom window, and RSI is more likely to move higher than lower. though it does have this volume by price band overhead to deal with. This is a useful indicator, the New York Stock Exchange high-low. It compares the 52-week highs and 52-week lows, and as we can see, since March, off of the January-February lows, in March we moved back above the zero line and continued to move in a bullish direction. So 52-week highs are outperforming 52-week lows. We look nothing like we did earlier in the year or in 2015. We also don't look anything like going into that move lower in the summer of 2015. As we all remember, August was the crossover of the 50 and a 200 period moving average, which both are moving higher as well. So from this perspective, we can compare previous occurrences of prices moving lower to the current situation, which looks more bullish than bearish. Okay, so that's going to do it for me for this week. This is Cousin Benny coming to you from theclosingprint.com. Look for the watch list later tonight and a blog post prior to the opening bell that will highlight the few stocks that we find the most potential in for trades going into this week. Remember, it is the beginning of a new month, so fund managers will likely be putting money to work for the month of October. Take care. I hope this helps, and we'll talk to you soon.